We hear about the stock market all the time. It's on the news, in movies, but for a lot of us, it can feel like this super complicated, members-only club. So today, we're going to pull back the curtain. We're going to break down what it really is in plain English. Let's jump in.
Okay, so you know the drill, right? Your paycheck comes in, you take care of your bills, and if you're lucky, you get to slide whatever's left over into a savings account. And hey, that's a great start, for sure. But at some point, you might look at that savings account and just kind of wonder, is this really going to be enough? Enough for that down payment? Enough for retirement? Enough to just feel a little more secure?
So, what exactly is the stock market? Let's just forget all those images of people shouting on a trading floor and all the crazy-looking charts for a minute. At its absolute core, the stock market is just a huge network where tiny, tiny pieces of public companies are bought and sold. And these little pieces, we call them shares or stocks. Here's probably the easiest way to picture it. Think of a giant farmer's market. You've got all these stalls set up, but instead of selling fruits and vegetables, each stall represents a different company. You can walk right up to the apple stall, but instead of buying an apple, you're buying a tiny slice of the entire company, Apple Inc. And just like that, you're a part owner. It's that simple.
Okay, so it's a marketplace for tiny pieces of companies. But why? Why does it even exist in the first place? Why would a massive company want to sell off little bits of itself to millions of strangers? And on the flip side, why would we want to buy them? Well, it turns out it's a two-way street that actually helps both sides.
Let's look at it from both angles. So for the company, it's all about raising money to grow. They sell these shares to get cash to build new factories, hire more people, fund cool new research, basically to get bigger and better. And for you as an investor, you're buying a piece because you believe in that growth. You want to share in their future success. And, well, you want to put your money to work so it can grow over time. All right, let's get to the big one. This is what everybody really wants to know, right? You've bought your little piece of a company. So how does that actually turn into more money for you? It's not magic. And it really comes down to two main ways. So the first way is through something called a dividend. Just think of it like this. If the company does well and makes a profit, you might decide to share a little slice of that profit with their owners. And hey, since you own a share, that means you. It's like a little cash thank you for being an investor. Now, the second way is what most people think of. It's called a capital gain. Basically, if the company you invested in does well, its value goes up. That means the price of your little piece goes up too. And if you decide to sell that piece for more than you paid for it, that profit you make, that's your capital gain. But, and this is probably the single most important thing to get, it is absolutely not a one-way street. Prices do not just go up. As investor.gov says right here, no one can guarantee that you'll make money, and they may lose value. If a company hits a rough patch or the whole economy slows down, the value of your shares can definitely fall. There are zero guarantees here.
In understanding that risk, well, that brings us to a really critical point, your mindset. How you approach the market is everything. It's what separates being an investor from just, well, gambling.
This is a really key difference. On one side, you have investing. Investing is a long-term game. You're looking at the actual health of a company, its leadership, its products, its potential to grow over years. The goal is to build wealth, steadily. But then you have trading or speculating. That's all about the short term, trying to profit from the little price swings that happen day to day. And as you can probably guess, that's a much, much riskier approach.
This is such a common trap for beginners. It is so easy to get hooked on the daily ups and downs and treat the stock market like a casino, just hoping to hit the jackpot on some hot tip. But real, solid investing, it's way more like tending to a garden. It takes patience, you got to do a little homework, and you have to understand that things grow over time, not overnight. And that long-term view really is the whole ballgame. I mean, this quote from investor.gov pretty much says it all. For most of us, investing isn't about getting rich quick. It's a patient strategy, something you do over many, many years that can help you build real financial security. It's about letting your money work for you, steadily and slowly. So, we've walked through what the market actually is, why it exists, how you can make and lose money, and the right mindset to bring to the table. So, where does that leave us? What's next?
So look, the whole point of this was never to tell you what to invest in, but just to show you that the stock market isn't some secret, scary thing. It's a tool. And the real takeaway isn't about chasing some get-rich-quick scheme. It's about a shift in your thinking. So instead of asking, how do I get rich quick, the much better question becomes, okay, now that I get the basics, how can I find my place in all of this?